Well, hey, everybody. Nate Miller here, Miller Retirement Group. And in a time when our country is maybe more divided than it's ever been, and there are many things going on right now that some people love and some people absolutely hate, I wanted to take this time to talk about some actual good news. Let's talk about something that's actually going right. Philippians 4:8 says, "Finally, brethren, whatever things are true, whatever things are noble, whatever things are just, whatever things are pure, whatever things are lovely, let's meditate on these things. And if there's anything, sorry, I skipped something there. If there's any virtue and if there's anything praiseworthy, meditate on these things." There we go. So that's what we're going to do today. We're going to meditate on the good. There's quite a bit that's going on right now. And a lot of the following is taken from an interview between Joe Livornia, counselor to the Treasury Secretary Scott Bessent, and Daily Wire senior editor Cabot Phillips. A surge in business investment is reshaping the U.S. landscape. The latest data from the Federal Reserve shows an uptick in capital expenditures, one that rivals the heights of the late 90s tech boom. And so first, I want to talk to all of you about some new numbers that are coming from the Federal Reserve right now that are showing a significant increase in the U.S. production of business equipment. Now, to give us some context on why that's a good sign for the economy and what this means for average Americans, the Federal Reserve provides industrial production figures every month. And one of the details is often overlooked in the market, and that is production of business equipment. And that's an excellent proxy for what economists call CapEx, or capital spending, which essentially measures all the things that firms invest in to help produce more of the goods and services that people want. It could be computers, IT, software, whatever. And what we observed in the first quarter is that the equipment production rose at a 23% rate. And not surprisingly, when we got the GDP data, we saw a 24% increase. So that's really strong, really exciting news. And Livornia says they think that part of it could be a result of the One Big Beautiful Bill, which had retroactive expensing to Inauguration Day. And so companies were getting very excited about the pro-growth policies that President Trump was putting forward and took that initiative in the first quarter, increased production of business equipment, and we saw that in the GDP amounts. Importantly, though, in quarter two, we saw another large gain in business equipment production, almost up 11%. So that's a really strong increase following the huge boom in the first quarter. And so what that means is before the One Big Beautiful Bill even became legislation, we had an almost 17% annualized increase over those 2 quarters of business equipment production. And so for those not spending their evenings being economy nerds, those are pretty remarkable numbers. Excluding the pandemic, this is the fastest two-quarter gain since the last 2 quarters of 1997 during the heart of the internet boom. So what we're seeing is how businesses reacted in anticipation of the bill. And the bill's now passed, which means that now we could see even a much higher glide path, much more growth in capital spending, which means it's going to reinforce the blue collar boom that we've already started seeing. And this is all very consistent with what Trump has wanted and what Secretary Bessent is also helping to push through. So as Livornia in this mentions, this trend actually started back in quarter one, even before the Big Beautiful Bill passed, when we weren't even sure whether or not it was going to be passed. So another question could be, well, what could some other reasons be that we could be seeing this trend beyond just the One Big Beautiful Bill? And in the interview, Livornia really didn't give another reason. He basically said, well, certainly an 11% quarter two gain was fantastic, but maybe it could have even been stronger if people would have taken President Trump at his word and realized he was going to get the bill done by July 4th. So he's actually saying it was 11%, could have been even higher if people would have thought Trump was going to get it. And so he didn't really give another reason of why that increase could be happening. But the bill also does contain a lot of other pro-growth policies, such as faster permitting as it relates to energy production, the ability of energy producers to tap federal waterways and land for drilling, which is something they could not do under the previous administration, essentially making it easier to conduct business with low and stable tax rates that are now permanent. It's actually encouraging people to spend. And this bill also includes 100% expensing if you build a new plant, a new factory. That wasn't the case in the first bill. So what got passed was actually even better. And so now, if you want to build things, if you want foreign capital come in, which is what's happening in large part because of the tariffs have incentivized countries to come in and companies to actually do business in the U.S. And well, they're going to have cheap and abundant energy. They're going to have a much friendlier regulatory backdrop. And if you are a U.S. producer, you are now going to be able to expense the factory that you wouldn't have been able to do before. So imagine that in startup costs. So it's really kind of a reindustrialization. And Livornia he's calling it a manufacturing renaissance. Fun term, right? But it is what President Trump was describing as the golden era. And he believes that we are now upon that happening, and this capex comeback is consistent with that. And so if you go through the Fed data, Livornia says that one thing that caught his eye was the lack of increase in tariff sensitive goods. And this was something that was really surprising to me, too, because economists have been saying that all of these products in particular would see a large price increase over the last few months. And heck, you can even go back to some of the podcasts where I was talking about the tariffs. I even said that, and it's just not happening yet. And so to give all three of my listeners a little bit more context on what tariff sensitive goods are and maybe why in his view the prices are not increasing. So there are some products that might have a tariff effect. It's very hard to figure out what the tariff effect is, in large part because the economists for 5 months in a row have been saying that there's going to be inflation in the data, and we had 4 months in a row where the data on the CPI surprised to the downside. The fifth month was in line, but then we had a very good PPI and import price data. And so if you look hard enough, you could find almost anything. But what we know is, broadly speaking, in the latest PPI data and in the import price data that followed, there has been virtually no inflation at all coming from China, which, as we know, was our largest. I mean, we were in our largest deficit with China. And without question, we know that the pricing platform, generally speaking, has been much lower than expected. And so on all these goods that have had tariffs applied to them, we haven't seen the increase in prices that we all thought was going to happen. And so I would argue that going forward, the likelihood that we see an acceleration in inflation to what people think is extraordinarily low. And if at some point there is an adjustment, it'll probably basically be like a one-off price level adjustment, and it's not something that'll just self-perpetuate. I mean, inflation is a monetary phenomenon, and we see inflation expectations coming down. We know interest rates are still historically high for reasons that have nothing to do with trade, but we do expect backdrops to improve there. And we've I talked quite a bit about this this episode about all the positive signs regarding to the U.S. economy, but there is still some concerning trends as well. I mean, for example, we saw within the last recent weeks that manufacturing in the Mid-Atlantic region here domestically has decreased dramatically. But mainly the broad data still looks really good. I mean, there's always going to be these pockets of softness and some of these more qualitative metrics that have been weaker depending on which ones you're looking at. But as far as the overall data, it's not really there. The overall hard data is very strong. So now the bill's done. So if we're looking forward, to us, it's very positive, and especially, I mean, we've already seen this big capex improvement. So I would say let's stay focused on the big picture and this harder data, which has clearly shown a V-shaped recovery in capex. And so President Trump campaigned on a promise to bring investments from around the world here to the U.S. to benefit the American workers and our economy. And that is happening. We've actually seen trillions now of dollars worth of investments pouring in, onshoring of jobs and manufacturing. And we saw AstraZeneca just within the last couple of weeks announce a $500 billion investment. And here recently, Trump just negotiated a huge deal with the European Union for even more investment in the U.S. As part of the deal, per Trump's description, the EU will purchase $750 billion worth of energy from the United States, and that's coming over the next few years. They're also going to agree to invest $600 billion more dollars than the bloc is already investing. They're also opening up its countries up to trade with America, and they're also going to buy a vast amount of military equipment. They haven't put a dollar sign on that one. It's just going to be a big amount. We don't know what that is yet. And also, Trump noted the tariffs for automobiles and other EU imports will be a straight across the board rate of 15%. And we're not actually being tariffed by them either, hence more of the opening up of their countries to doing trade with us. And so over the past couple of months now, following, quote, Liberation Day in April, the Trump administration has struck even framework agreements with countries like China, the UK, Indonesia, And also, Trump revealed here recently that Japan would invest over $500 billion into the United States in what he was calling perhaps the largest deal ever made. South Korea is also working on a trade proposal before it faces a tariff hike at the beginning of next month. And so, what's happening? What is driving that? I mean, this is not just one company and it's not just one country. I mean, I don't know if the total amount of investment now in the US because of all of this is sitting at 2 trillion, 3 trillion, 4 trillion. It's like it just keeps going up. And so now these are capital commitments that will occur over time. They're not all happening in 1 year. And this is why, though, we needed the bill to be passed because it made permanent a lot of these tax changes. So now there's some clarity on what the tax policies are going to be because it's kind of hard to make spending decisions if your tax rates if you don't know what your tax rates are going to be. So that's part of it. And again, that includes the deregulation, the energy encouragement, energy encouraged production. Those are all incentives to come in. And of course, it's overlaid with the tariffs and also President Trump's negotiating. It all kind of just fits together. So different companies are going to be moving at different paces. Trade deals are still being negotiated, but we do expect a lot more good news to come in the months ahead. And you're probably going to see a much more fair, much more America First trade situation going on. And so at the same time, you're getting manufacturing industrialization in a way that's going to benefit the middle and lower income workers, which was a hallmark of what President Trump first set in his policies in his first administration. And it's coming back in even a bigger way this time around. And so we've definitely seen investors take a more rosy outlook on the economy. If you look at the numbers, the S&P hitting record highs, Dow, global markets in Asia and Europe also picking up steam. And so they're clearly optimistic at this point. But what's interesting is if you look at the polling data, it seems like Americans are still more skeptical about President Trump's handling of the economy than you'd think. So he's actually double digits underwater right now on that issue, at lower than any point in his first term. And so the message is probably their messaging is not very good right now. But I would say the message to Americans should be, looking at the polling, I'd always be a little bit careful because I think some polls can be a little inaccurate depending on who they're asking. So if you're not all that confident right now in President Trump's economic strategy, let's look at the bigger picture and actually all the numbers that have coming out right now and what we've been highlighting. Of course, the fact that in the first 6 months of President Trump's term, blue collar wages, which are technically what are known as non-supervisory production workers, so the backbone of the labor market, we've seen a 1.2% increase in their wages in the first 6 months of President Trump's term. And that is the second fastest of all time, only behind the first 6 months of President Trump's first term, 1.3%. And so now with the one big beautiful bill in place, the CapEx comeback that we're seeing, that's only going to continue to foster and galvanize further gain in wages. And that's going to show up in people's take-home pay, bigger paychecks, better jobs. And that is ultimately going to lead to what Trump has been calling that golden era. So, and you're going to start seeing it reflected in all sorts of numbers now, too. And so switching gears here a little bit, Trump has made no secret that he's not a fan of Federal Reserve Chairman Jerome Powell. He's calling for an investigation into the Fed's renovation project, which has gone well over budget. And now Livornia's boss, Treasury Secretary Scott Bessent, is conducting a thorough review of the Federal Reserve that goes beyond just the renovation product. And what exactly is he looking for? We'll have to wait and see. I mean, clearly there's a focus on this administration of eliminating waste, fraud, and abuse and whatever projects there are that the government's involved in. So if it looks like there's cost overruns that can't be justified, we need to look at it. And I think that's prudent. I think that's a very prudent, thorough approach. And so we'll see what the results end up bringing, of course. But the final question I'd like us to think about is there is a lot of talk in the economy and a lot that's hitting headlines right now. But how about something that is being under-discussed or underreported that gives us reason for optimism even? And this is what President has talked about, of course, interest rates. Maybe you guys have been following that conversation, maybe not, but interest rates are high right now. Housing market is soft. I mean, if you've got interest rates in like the 6% and plus, that makes your monthly payment pretty darn high. And so a lot of people aren't going to be buying homes with that type of a monthly payment. They're going to wait until those rates come down and then start buying. So the housing market is a little soft right now. First time home affordability is historically low at this point. One of the reasons that Trump's wanting Powell to lower those rates. Inflation numbers have been sitting at about 2.4% right now. So they're kind of right in line. We haven't seen the increase in prices. And one of the things that Powell has mentioned being afraid of or cognizant of is possible increases in prices due to the tariffs. Well, we've now seen that has not happened at near the level that people thought were going to happen either. And so I'm in favor of some interest rate cuts, definitely. And so President Trump's policies, as far as we know from what he's done on the wage side, they are benefiting America and Americans in particular. They're actually pretty focused on the middle and lower income. And so that's what they're wanting. They need those lower interest rates to be able to afford a home. And he mentioned some qualitative manufacturing surveys to the extent that interest rates are high. And that's also at the margin going to dampen manufacturing as well, more difficult to borrow money. And so if you want to look at areas of the economy that could do better if rates were lower, definitely manufacturing and housing would be the two main obvious points or places to look right there. So I know there are not a lot of reasons that some people like Trump. Some of those reasons valid, some maybe not, but just like within any administration, right? But so far, what he is doing for the economy is going in the right direction, and the numbers are actually showing it now too. And that is good news for our pocketbooks and good news for our portfolios. And if those of you that are my clients have heard me say it many times, I'm registered independent. And so I don't care about the politician or the party. I care more about the policy and how that affects your pocketbooks and your portfolios, because that's what I'm trying to manage for all of you in retirement, give you bigger paychecks in retirement, bigger pocketbooks and bigger portfolios. So far, it looks like we're going in the right direction for the things that matter to my clients financially. And that's good news. So hopefully this helped some of you that might have that financial feeling in the pit of the stomach, that one that comes from financial anxiety that's like in that one spot in the stomach that is pretty much reserved only, I think, for financial anxiety. Hopefully this helps assuage. I don't know how to use that word, pronounce that word correct. Hopefully this lowers any of that financial anxiety that you might be having, because so far it looks like things are going in the right direction. So that's it. Thanks for tuning in, and look forward to seeing you guys here in about another week. Take care.